Welcome to Money Matters. I'm David Kroll from Mortgage Network, and standing to my left is Emily Johnson from Polaris Capital.
Good morning.
We are going to try to make sense of the economics of Bluffton County, of the United States of America, and the world. So bit by bit.
All in 21 minutes.
All in 21 minutes. So Emily's going to lead off today and basically crystallize for us where the markets have been for the last week, but where the stock market has been, bond market, where it's been.
I'm getting all the markets. I'm doing stocks and bonds. Okay.
Doing everything for the last week, and then I'll comment on why I think it's so.
Okay. Well, in a nutshell, in the stock market, the equities markets, the Dow, the S&P, it's just sort of been Superman for the last week and or several weeks by and large. And every single day, if it seems like the market's about to go down, it's just the little engine that could, and it just keeps trucking right back up again. So we have had a very, very robust market for the last several weeks. This past week is no different. One thing that is somewhat telling is, as we talk politics a reasonable amount on this show, is it doesn't seem that the market is just solely being driven by politics, at least right now, because of course we're yet again in another earnings, just post-earnings, and it does seem that a lot of the corporate earnings, corporate fundamentals are actually looking really good, meaning their earnings are increasing, are improving, meaning their balance sheets look better because debts have been
reduced.
Thank you. So just early in the morning. And anyway, so balance sheets are looking good, earnings are looking good, and so therefore the stock prices have continued to move up in pretty much every sector across the board, with a few little blips here and there, a few blips in energy, a few blips in technology, but by and large, most sectors are continuing on an upward trend. As far as bonds go, bond yields have actually been inching up little bit by little bit, but I don't want to speak a whole lot to that because the yield curve is something that is a bit of an enigma right now, because as we're seeing we look at the 10-year as a bellwether, and we look at the 30-year as sort of a long-term, where we anticipate the economy is going over the long term and what is the return on risk over the long term. So recently we've seen this bump up in that 10-year rate from 1.8 only a few months ago to about 2.4, 2.45 today, and yet the 30-year isn't moving in relative terms. So we're definitely seeing a higher jump on the front end of the curve and not a whole lot of move on the long end of the curve, which indicates that we don't expect that the markets in general are not expecting much growth over the next long term. So anyway, it's sort of been it's a flattening of the yield curve. So that's what's going on with stocks and bonds. I think I've just really
she knows her stuff. So why is this happening? For several since the day of the election, since November 8th. Stocks have gone up 9.7%. This is a very, very, very dramatic rise. And there's lots of people who actually missed that increase. I largely missed it because I've been in a very defensive posture for some time. You've heard me on the show. I've been waiting for the great adjustment to come, and it hasn't come. And
I likened it the other day to betting against Tom Brady. I mean, which I know probably a lot of you out there will hate, but truly, you can't really bet against Tom Brady, and it's shown, and it sort of feels the exact same with this market right now. Of course, that's when
this market, and to Emily's point, to the Tom Brady point, this market is feeling more and more resilient, and yet, from a big global economic perspective, there's still a big why. There's still a big kind of chin scratcher in there. I think, and I continue to think, that the biggest single reason for the resilience of the market is the surplus of capital looking for a home and looking for some kind of a return.
Right, and as we were talking slightly a little bit before the show about this, and obviously Trump, they expect, was elected primarily by the center of the country, not by the Northeast or by the West Coast. And yet that is where the bulk of the money in the United States is, and they're not walking on their investments right now. They're still sitting in the market. So for all of those that didn't want Trump to become president, they're not taking their monies out of hedge funds, mutual funds, ETFs, individual stocks. They're still sitting there and enjoying the fruits of this rally. But that said, there's still a lot more cash on the sidelines, most of it from other sovereign nations. And
That's correct. And so we're having the phenomenon of lots of this odd phenomenon that occurs when there's simply too much money to be invested and all of it seeking a return. I think that the continued investment, institutional investment in the stock market is because there's simply too much money, and in search of a return, they have convinced themselves that the rally is more resilient than it actually is.
And that's a very interesting point.
Is.
Exactly. So when you talk about institutions, you're talking about endowments, you're talking about insurance companies, et cetera. Interestingly, pensions are one of the biggest drivers, and this is sort of is the tail that wags the dog.
Not supposed to be.
But isn't that the tail that wags the dog?
Yeah.
So pensions, so think like municipalities, teachers' pensions, et cetera. They're most
CalPER,
exactly.
California.
So pensions have an assumed rate of growth that is built into what those individuals who work for those institutions will be paid when they retire. And that assumed rate of growth is somewhere in the neighborhood of 6.57%, depending on which pension we're talking about. That's actually down, but it was only lowered slightly in the last couple of years. So that means for the last several years, these pensions have had, and we're talking billions and billions of dollars, have had an assumed rate of growth of about 7%. Well, that hasn't materialized year over year over year, especially when you have pensions that have to be relatively risk averse. So that means that these pensions can't go and invest everything in Enron and wing in a prayer and hope that it ends up okay. They have mandates that they have to invest a certain amount in fixed income. For those of you that watch, you know that fixed income is not yielding a whole heck of a lot. Certainly not 7%.
1%.
You might be lucky, yeah. If you're somewhere in the neighborhood of 2, you'd probably be on the high end of that. So if you're looking at that average, that means that the pensions, again, billions and billions of dollars, have to invest in the markets in order to get that 7% yield, or at least pray that they can. There's no chance they're going to get it in fixed income securities, at least as it stands right now. So it's sort of that tail wagging the dog conundrum, because these pensions will have to pay individuals as they retire. The baby boomers, and for municipalities and state employees, that's going to continue forever. Now, private corporations and also publicly traded corporations, most of them have gotten rid of their pensions. There are still some large companies that do offer pensions, but for my contemporaries anyway, pensions have gone the way of the dinosaur. So by and large, these pensions, they're going to have to pay out the majority of their funds in the next 30 years. So they have to have their money invested. It's interesting to think about the billions and billions of dollars that are solely there hoping for that gain, praying for that gain, because it's in their mandate. You and I have a 401k. We put money in our 401k. We base it on various models. We also have that same anticipation of growth for the next however many years, but we don't have a mandate that says that.
And that's one of the elusive things in the market at the moment, which is a serious question, which is the market driven by its fundamentals, or is it driven by the expectations of return of the principal investors in the market? So this is always a conundrum. It's a difficult one. And what we're seeing at the moment, in addition to that whole phenomenon, which is institutional support of the market for its own sake, what we're also seeing is institutional support of the bond market. So you have the stock market going up, you also have the bond market very stable and or inching up at the same time. Always in the past, we've explained that the stock market goes up, the bond market goes down. They are counterbalancing to one another. They're supposed to be counterbalancing. At the moment, not so much. And not so much because, why? There's too much money to be invested, and these are the only two safe places to put the money, or the only two regulated and reasonably safe places to put the money.
Until, of course, you look at private investment, which you're also seeing an increase in. And I know when I talk to, I'm sure you see this all the time, when I speak with realtors, the second home market here in Hilton Head and General Beaufort County is booming because there is a lot of that excess capital that people are now feeling flush again. And so investing in a second home or investing in a maybe an investment property, but a second home they can rent out is definitely on
And
the
we're
upswing.
going to talk more about that leg of the stool, bonds, stocks, real estate. We'll talk more about the real estate in the second half of the show.
Please stick
So-
with us. We'll be right back.